Welcome to This Week in Money. I'm Jim Goddard. Today, Bob Hoye from Institutional Advisors will take a look at the commodity markets for us. KC Research Chairman Doug Casey on what he thinks of the so-called FAANGs. He believes the U.S. has actually been in a soft recession since the 2007 crash. He tells us anything Trump can do to help the U.S. economy will be good for Canada in the long run. WolfStreet.com publisher Wolf Richter says more than half of U.S. retail is untouchable by e-commerce, but department stores are being decimated. Plus, right after the show, we'll have a company showcase update from American Manganese President Larry Reaugh. We'll talk to Bob Hoye right after this.
Arctic Star Exploration, operated by a team of proven mine finders, is focused on diamonds in Finland and the Northwest Territories of Canada. A work program is planned for our Finland property that contains diamond-bearing kimberlite. Arctic Star trades on the TSX Venture Exchange, symbol ADD, and the Frankfurt Exchange, symbol 82A1. Please visit our website at arcticstar.ca or call us at 604-689-1799.
Welcome to This Week in Money, the source for market opinions. Here is Jim Goddard.
My guest is market historian Bob Hoye. He's the chief investment strategist for institutionaladvisors.com. Welcome to This Week in Money, Bob.
Yeah, Jim, it's good to be with you.
What's happening on the commodity markets this week?
Oh, gosh, there's kind of all over the place. We've been figuring that industrial commodities would goes back to early October, would basically recover into December or January, which would be for copper and crude oil would be in defiance of usual seasonals, but everything's pretty wild this year. So we're this week a rally in crude oil to new highs, being helped, of course, by a weaker U.S. dollar. Copper's been somewhat firmer, but 3 months ago, lead was the darling of the base metals, and they peaked in October and are slowly coming down. And similar with aluminum, essentially the base metals are not really acting well. And then you've got some exotics like they're talking about with lithium. To give you an idea, that was down to 80 in 2016, up to 145 in September, and basically the same price now. Then there's the other exotic favorite, cobalt, 24,000 in 2016 and 61,750 in September, and it's essentially the same price now. So are those two exotics kind of working on a rounding top here? Who knows? But over in the on the real side, like iron ore, it got up to 175 in 2011, and then down to 90 in March, and then it was 80 in September, and it's 63 now. So the foundation of construction and production, weak prices. Let's look at another one here. Metallurgical coal, that of course goes into making steel, was at up to 185 in 2008, down to 54 in 2016, and in the since summer it's rallied up to 205. So it's on a good rally. And then thermal coal, it was up to 140 in 2008, and it's 40 now. So the permeables in commodities haven't been consistent winners. Looking back on it, 2008 was a huge rally in crude oil. That got up to 147, and our technical work identified that as a secular peak in the crude oil price, which it was, $147. Then in 2011, we had great excitement in base metal prices, and in the nominal price, which is the one you see day to day, as well as in the deflated or the real price. And we argued at that time that the price in real terms had been high enough for long enough that it would prompt a huge expansion in capacity, mining capacity, smelting capacity, which it did do. So you've had a long decline in base metal prices. Also, 2011 was the speculative peak in the gold and silver mania, right up, and it triggered off some of our technical signals and generally been in decline now. But what you get throughout history is that when you're in a financial mania, which we are in, and the hot action is in the financial assets, bonds and stocks, you don't get a good play out of the precious metals. This then has been confirmed one more time. But the big market can't go forever, and the precious metals can't remain dull and weak forever either. So, but perhaps next year the picture for precious metals would improve, maybe in the first quarter. So the other commodity sector, lumber. Wow, it had a huge rally until about 3 or 4 weeks ago and became exceptionally overbought, and it has had a good correction. The zest in the lumber rally was helped by the concept that with the storms that hit the U.S. in August, that there would be a lot of housing construction and 2x4s and everything else. But so it became the darling for a while. On the other side, the sector that has been dull and down has been agricultural products, the grains and things like that. And they've been weak until the last month when it looks like they're building a base. And the index, the GKX, is the index for agricultural products. And it's been improving, up and a little correction back and then another move. So it's been establishing new highs. And it's above 50-day moving average. So that's constructive. But don't see a chance for a huge bull market in grains. There's terrific capacity. And then the people who have a fear of CO2, it's actually helping out in stimulating growth of all plant life, and I expect it'll help out with agricultural products. So, we're looking for a rally, but not a huge bull market for the grain sector.
Bob, thank you so much for being on This Week in Money.
Anytime.
My guest has been market historian Bob Hoye. He's the chief investment strategist for institutionaladvisors.com. Coming up, Doug Casey, founder of Casey Research, next on This Week in Money.
Always consult your investment professional before making any investment decision.
I'm Brian Fowler, president of Blind Creek Resources Limited, listed on the TSX Venture Exchange, ticker symbol BCK. Blind Creek is focused in the Yukon, Northwest Territories, and British Columbia. The company's key property is the Blend Project, one of the largest undeveloped lead zinc silver deposits in Western Canada, plus plans to advance the recently acquired, fully permitted historic engineered gold mine in the Atlan district of northwestern BC. Check us out at blindcreekresources.com.
I'm Bill McWilliam, president of Cascadero Copper, CCD on the TSX Venture Exchange. Cesium is one of the world's rarest metals with a growing industrial demand. Drilling is underway on our Tehran property in Argentina to prove up a cesium resource. Cascadero's patent-pending leach process has the potential to make Cascadero the lowest cost supplier of cesium in the world. Visit our website, cascadero.com, or phone us at 604-924-5504.
Cypress Development Corp's flagship lithium project is located just east of Albemarle's Silver Peak mine in the heart of Clayton Valley, Nevada. A 12-hole exploration drill program for lithium-enriched claystone on Cypress's 100% controlled properties is now underway. Cypress Development Corp trades on the TSX Venture Exchange, symbol CYP, the Pink CYDVF, and on Frankfurt's C1Z1. For more information, please visit our website, cypressdevelopmentcorp.com.
This Week in Money is archived online at talkdigitalnetwork.com.
Welcome back to This Week in Money. I'm Jim Goddard. I'm speaking with Doug Casey, founder and chairman of CaseyResearch.com. He's speaking to us from San Francisco. Welcome back to the show, Doug.
Thank you, Jim. It's nice to be here in San Fran and on the show as well.
The Dow continues to go higher. In fact, all the major equity markets in the U.S. seem to be making record highs daily. What do you see ahead for the Dow in the new year?
Well, on the one hand, it's an old saying, trends in motion tend to stay in motion. But I have no interest in the stock market right now. It's, by all historical parameters, very overpriced. I like to buy things when they're cheap. Now, there are areas of the stock market that are very cheap, such as shipping stocks. They're down 90% when everything else is up. I don't own any yet. I'm looking to buy them. Offshore oil drilling stocks, same situation, down over 90%. And mining stocks, which have always been a favorite and a specialty of mine. They've been in a 6-year bear market. That's the type of thing I'm looking at. I have no interest in chasing after the so-called FAANG stocks, Facebook, Apple, Amazon, Netflix, Google. I think they're an accident waiting to happen. They're a bubble.
Do you see this as being a bubble very similar to the one that happened in 2000 when we had the dot-com crash? Here, again, we have the high techs leading the way. Are they in danger of being the leader in a crash?
Oh, there's no question about it. And people forget that was a full generation ago. That was a long time ago. That's becoming ancient history. Most people have forgotten. Another old saying from the stock market, high tech, big wreck. After mining and resource stocks, which are the most volatile stocks in the world, tech is the second most volatile area of the market. So if you want to make money in anything, but especially in tech, you've got to pick the right stocks out when they're cheap, not chase after them after they've gone up by many hundreds of percent.
Does the Dow hitting a record high and then having a correction always signal a recession about 6 months later?
Well, the reason that we have the Dow and stocks generally running ahead is because of government monetary policy. Since 2007, all the governments of the world, not just the U.S. government, but the Europeans, the Japanese, the Chinese, and all the smaller countries, have been printing up money by the trillions, by the tens of trillions of currency units, dollars, euros, yuan, what have you. And all that money has flowed into the stock markets and the bond markets and the real estate markets. It hasn't evidenced itself to the degree it could have in the price of retail things that you buy, food, clothing, things of that nature. But it will. So I think that the next downturn in the economy is going to be accompanied by very high levels of retail inflation at the same time as these inflated financial markets come down a lot.
Is the trouble in retail signaling the U.S. is on the cusp of a recession?
Well, I'm of the opinion that we actually entered what I call the Greater Depression in 2007. You'll notice that even though governments have created scores of trillions of new currency units all over the world, the standard of living has been struggling. The rich have been getting richer, and people in the middle class and below have been falling. We're actually in a depression, and it hasn't been much worse because these governments have created all this money, which has buoyed up the financial markets. But that money now exists, and it's going to be reflected in retail prices, and that's going to hurt the average guy a lot. So I think we're already in bad times. It's just a question of will we go out of the eye of the hurricane, where we are right now, where they've poured all this oil on the water in the form of money, and go into the trailing edge of the hurricane, which is going to last much longer and be much worse and be much different than what you recall from 2008 and 2009, when things nearly went over the edge.
Does the U.S. dollar look bullish or bearish for 2018?
Well, look, the dollar is still the world's currency. Everybody settles with it. Even the Chinese and the Russians, when dealing with each other, are still using the dollar. The Indians and the Iranians dealing with each other use dollars, which is rather insane, because these people don't appreciate the fact they have to use the unreliable currency of a potential enemy government, and everything has to clear through New York. So what's happening is the dollar is going to be dethroned. The Chinese are trying to make the yuan an alternative as a world currency, and I think they're going to succeed. Actually, I think they're going to wind up backing the yuan with gold, and the dollar is going to be on its way out.
Would we see a petro-yuan then use the yuan to trade oil instead of the U.S. dollar?
I think that's happening. And they're going to come up with an alternative to the SWIFT system to transfer money around the world. It'll be a separate system so that you don't have to do everything in dollars through New York. And you got to remember that Saudi Arabia, which is at this time it's between the Russians, the Americans, and the Saudis for who's the biggest oil producer. It's the petrodollar. They're pricing oil in dollars. But the Chinese buy much more oil from Saudi than the Americans do. And the Chinese are going to work it out so that the Saudis take payment in yuan. The dollar can be dethroned, and when people don't have to hold it and use it, they'll get rid of it, and the dollar could collapse.
Gold and silver have been trading in a range. Do you see them breaking out to the upside or the downside in the new year?
No, it's got to be to the upside, because you got to remember all commodities, wheat, corn, soybeans, gold, silver, everything. They hit their last high in 2011. Now that was 6 years ago, over 6 years ago, and it's been basically a bear market since then, flattening out for the last couple of years, bouncing along the bottom for the last couple of years. So as volatile as commodities are, the next step is up, and that's the place to be. It's to be in commodity-related things in the future.
Is 2018 likely to be a good year for the bond market?
The bond market is in not just a bubble, it's in a hyper bubble. So it's actually an ideal short. Interest rates are headed up, and people forget what interest rates were not just a generation ago, but 2 generations ago, back in 1980, when the U.S. government was paying 12, 15% and more for its borrowed money. And I think they're going to have to go back to that level eventually, as unbelievable as that sounds, with interest rates now at 0%, 1%, 2%, and even negative numbers in Europe, which I thought was metaphysically impossible, but anything is possible, I think, with the kind of people that are running the monetary systems today.
If interest rates continue to rise, what could happen to the too big to fail debt bubble?
Look, this could all blow up. It could all blow up. That's why I really suggest that people try to put as much as they can into physical gold and physical silver. I don't know if you remember, Jim, but my second novel in this series of 7 novels that I'm writing is called Drug Lord, that explains the drug business and a lot of these monetary aspects that actually have to do with the international drug business. I'd like to mention that to listeners. Just as last year, a lot of these things to do with mining and stocks and speculation were in my novel Speculator.
Doug, are banks starting to constrict lending, and what effect could this have on the economies of Canada and the U.S.?
Well, because of the fractional reserve banking system, where banks can literally lend the same dollar out many times, most of the banks in the world are either walking wounded or actually bankrupt. So if you'll recall what happened 3 years ago in Cyprus, the banks weren't bailed out by the government because the government was bankrupt. The banks were bailed in, where people that had over 100,000 euros in any Cypriot bank lost the money. And we could see that happen in North America as well. The problem is the whole world is floating on a sea of debt right now. When you have a lot of debt, it means that you've been living above your means. Just as when you have a lot of savings, the opposite of debt, it means you've been living below your means. And the amount of debt in the world, it's either going to be inflated out of existence or it's going to be defaulted on. And both of these are disasters for savers. I can't say how bearish I am right now about what's going on in the financial world, despite the fact stocks and bonds are at an all-time high. They don't have much to do with the real economy. Now it's got big trouble ahead.
We'll have more with Doug Casey next on This Week in Money.
Glance Technologies owns and operates Glance Pay, a disruptive mobile payment technology now live in 16 cities in Canada and about to launch in the U.S. With revenues up 664% in the last quarter, Glance Technologies has the potential to be a worldwide leader in an industry projected to grow to $1.3 trillion in 3 years. Glance Technologies stock symbols are GLNFF in the U.S. and GET in Canada. Find out more at glancepay.com.
Lotus Ventures Inc. is a BC-based medical marijuana company poised to launch into the rapidly evolving cannabis sector. Lotus is in the final review stage of the Health Canada approvals to become a licensed producer, having arranged facility financing of up to $12 million, plus building permits for its prototype indoor production facility. Shares trade under the symbol J on the Canadian Securities Exchange. Visit our website at lotusventures.ca.
Hi, I'm Douglas Mason, President and CEO of Magnum Gold Corp. Inc., MGI on the TSX Venture Exchange. A 2015 drill program on the LH property intersected high-grade gold, including 16.9 meters of 13.58 grams and 11 meters of 20.66 grams per ton gold. A follow-up drill program is planned to further evaluate previously identified subsurface high-grade gold mineralization. Please visit our website at magnumgoldcorp.com.
This Week in Money is archived online at talkdigitalnetwork.com.
Welcome back to This Week in Money. I'm Jim Goddard. We're speaking with Doug Casey, the founder and chairman of CaseyResearch.com. Doug, what do you think of the new Fed Chair, Jerome Powell?
I think that he's cut from exactly the same cloth as Yellen and Bernanke were. He's a believer in Keynesian economics. He's going to therefore print up lots of money. But he has no alternative. If he doesn't print up lots of money by buying more government debt and keeping interest rates low, the whole rotten system could collapse. So more of the same. But listen, I like to look at the bright side of things. And printing up as much money as Powell is bound to do is going to create more bubbles. More bubbles in the stock market, more bubbles everywhere. So if you keep your eye open for these bubbles, it could treat you very well. It's kind of like a question of you can profit from the collapse of Western civilization. It's perverse.
Is the bull market in marijuana stocks likely to continue?
I believe it is. There's been a lot of volatility in the marijuana stocks, but I'm a believer in buying the quality, because eventually marijuana is going to get as big or almost as big as the liquor industry. is. And not only that, it has very serious, very genuine medical uses. This is going to be huge. In addition to that, hemp, which is basically the marijuana plant for other purposes, is going to be very big in clothing, and it's going to replace a lot of the current paper industry and pulp industry. So the whole thing is going to get big, and I think that as major companies in the world today want to get into marijuana to capitalize on this, they're not going to start from ground zero and make all the mistakes that you make when you try to build a business from the ground floor. They're going to acquire companies that are already successful, that are publicly trading. So I think that the marijuana space is going to be a good space to be in for several years, for years to come, despite the fact that the market as a whole is overpriced. So I like the area.
Is the demand in the electric vehicle battery market causing a bull market in some of the base metals?
Absolutely. There's plenty of lithium in the world, so that's not particularly a place to be right now. But nickel and cobalt are very important for these batteries, and there really aren't any cobalt. Well, there's one cobalt stock out there, but cobalt is usually a byproduct metal, number one. And number two, most of the cobalt in the world comes from the Congo, which makes it especially complicated. But yes, batteries are in many ways a play on nickel and cobalt, so people should do a little bit of research on the companies that are mining in those areas, although they're mostly byproducts, especially cobalt.
Are cryptocurrencies the new gold for the millennial generation?
I'm a big believer in the blockchain technology. I was a late adopter to the cryptocurrency applications of blockchain, like Bitcoin, because I originally didn't see that its value as a money was as a transfer mechanism. It allows you to send money anywhere in the world quickly and cheaply without using the banking system. And this is going to be very, very important for the third world countries, where 3/4 of the people in the world have to use worthless currencies like kwaches, pulas, and pesos, that they're worth nothing outside their home country and not much within it. So I think that the Bitcoin-type currencies, there are many of them at this point, most of them are garbage, but and it is a bubble, but I think this bubble is going to get bigger. I wouldn't go overboard in them at this late stage, though.
Are cryptocurrencies likely to have a .com-like bust?
Yes, it's going to happen eventually, and they're very volatile and have been very volatile all the way up with 25-30% drops. Of course, I think Bitcoin is either at or close to another all-time high today, over $8,000.
Are governments trying to create their own cryptocurrencies?
That's going to happen too. All these governments are trying to get rid of paper currency. They say, oh, it's only for drug dealers and terrorists and child pornographers and so forth that want to use cash. This is nonsense. It's ridiculous. Cash gives you freedom. But all the governments of the world are trying to get rid of cash. $100 bills, even $50 bills. And they're going to want to go to their own cryptocurrency. But I wouldn't want to use a government cryptocurrency. They'll inflate it just the way they do their paper currencies, and they'll be able to track absolutely everything that you have and everything you spend money on, where all your income is and so forth. You have zero privacy. So yes, governments are going to that, but it's a very bad thing.
Does the Bitcoin market lack liquidity?
Yes, because there aren't that many people involved in it yet. There's 7 billion people in the world, and how many people are there that actually have Bitcoin, that own it right now? I'm not sure what the number is. Estimates have been made of 25 million, but active users, probably only 5 or 6 million. But it's expanding at an exponential rate. So it's going to be much more liquid as time goes on. No doubt about that in my mind. And prices will go higher as more people get involved.
Can cryptocurrencies be bought with leverage?
Not to my knowledge. I don't think anybody lends to buy or speculate in these currencies yet. I don't believe so.
Who do you think's behind the creation of Bitcoin?
Well, it's somebody, a person or a group that calls itself Satoshi Nakamoto. I think I have that right. A genius, undoubtedly, and a billionaire, deservedly, for having applied the blockchain technology to, which is a very big deal, to cryptocurrencies. So whoever he is, I wish him well.
Will blockchain change technology as we know it?
It appears to be. It's going to make it possible to track everything. So there's going to be a lot less. It eliminates a lot of possibilities for fraud, a lot of possibilities for loss, for wastage. It appears to be a very big thing. There are people who say it's bigger than the internet, which is hard to believe. But it's still very early stages. So if you find a company that is going to be big in developing it, fortunes could be made.
Is President Trump improving geopolitics around the world by meeting with leaders of a number of countries?
Yes, he is, actually. And I'm so glad that Hillary Clinton wasn't elected. It's not out of the question that she'll wind up in jail before this is all over. So Trump, for all the problems that he has, is vastly better than his alternative that ran. So I'm not going to say I support Trump, but I support the fact that he's upsetting the apple cart. I'm not sure he'll drain the swamp, but he's at least making some of these creatures uncomfortable in Washington.
Is the Middle East the powder keg that could send oil over $100 a barrel in 2018?
Yeah, it's a super powder keg, actually. What's going on with the new ruler of Saudi Arabia? I wish him well. He wants to modernize that backward, medieval, theocratic country. Will he succeed? Chances are good that he'll succeed. But I just hope that something doesn't happen. He doesn't start a war with Iran or expand the war that he's got with Yemen, get the Americans involved in this somehow. Potential powder keg.
Uranium is in the news lately. What do you see ahead for uranium?
It's very cheap right now. It's cheaper now in real terms than it was when the last bull market started in around 2000. So, and the Chinese and the Chinese and the Indians are going to be building hundreds of new nuclear plants. There are about 400 in the world right now, but they're going to be building hundreds more over the next decade or two. The demand for uranium is going way up. It's at an all-time low in real terms. Very bullish on uranium.
Is there a global real estate bubble?
Yes, there is. Not everywhere, but in a lot of cities. And absolutely in San Francisco, where I am, and Vancouver, where you are. It's a good time to hit the bid.
People from China have been buying high-end real estate around the planet. If and when the real estate bubble pops, are the people from China likely to hold on to those properties for the long term or sell in panic?
I think most Chinese buyers have bought for cash, and most of them are buying to diversify their portfolios, internationalize themselves, to decrease the political risk of just being in their home country of China. So I think this is very wise. I think they're very smart to have done this. Even if they're overpaying for things, they're not speculating on higher prices so much as trying to diversify themselves. So
they're most likely to hold on to it.
Yeah, I think so.
What do you see ahead for junior mining stocks?
I think that that's the next big bull market. I think there's going to be, with all the money they're creating, there's going to be a bubble in gold and silver and other metals, and there's likely to be a hyper bubble in mining stocks. So this is the time to buy and hold on for a big run.
Is President Trump starting to make a dent in the deep state?
No, too bad. I'm sorry, I wish he would. But he's surrounded himself with all these swamp creatures. No, he's likely to be captured by it.
Does President Trump's tax plan look good for America?
Look, any reduction in taxes is good, but I don't think anything is going to happen. The U.S. government, even now, when we're not officially in a recession, is running $600 billion deficits. And when times get tough, it's going to be $1 trillion, $1.5 trillion annual deficits. So no, there's not going to be a tax reduction. The government looks out for itself first. It needs more money, which they'll basically print up. But no, I seriously doubt that they're going to reduce taxes.
Is Trump's tax plan bad news for Canada?
God. Look, the best thing for Canada is that the U.S. does well, because Canada is the United States' biggest trading partner. So Americans should want Canadians to do well. Canadians should want Americans to do well, because they're big trading partners. But if taxes go up in the U.S., which are likely to do, inflation goes up in the U.S., which is likely to do, not good for Canada.
Does the deep state affect markets?
Yeah, absolutely. I mean, look, I'd like to pull the deep state out by its roots and put Agent Orange on the ground where it came from. But you can't get rid of it at this point. These people that live within the Washington Beltway, and the deep state has tentacles out everywhere. No, it's almost impossible to get rid of this thing at this point.
Doug, we talked about it briefly. How's your latest novel doing?
Well, the latest novel is Drug Lord, and it's following Charles Knight, who we met in Speculator, which talks about the mining industry and a gold fraud in Africa and a bush war. Now Charles is back. He's gotten into the drug business, legal, FDA-regulated stuff, and illegal, DEA-regulated stuff. And it's a morality tale, Jim, talking about the effects of drugs, how they're made, how they're marketed, the right and the wrong of these things. And, of course, I think that all drugs should be legalized, and Charles in the book does too. So I urge people to go to High Ground Books or go to Amazon and pick up both Speculator and Drug Lord, because you're going to fall behind otherwise, because next year Charles is going to be an assassin, where we are going to investigate the history and the techniques and the morality of assassination. So don't fall behind. Catch up with these books now.
Doug, how can people find out more about KC Research?
Well, go to kcresearch.com. Go to theinternationalman.com. Those are our two big websites. And we have a lot of free articles, very interesting. They're actually quite excellent. So you should go there and sign up. I think people will be very glad if they go to those two websites.
Doug, thanks a lot for being on This Week in Money.
Jim, my pleasure. Talk to you sometime in the future, the new year.
My guest has been Doug Casey, founder and chairman of KCResearch.com. He was speaking to us from San Francisco. Coming up, Wolf Richter next on This Week in Money.
Hi, I'm Douglas Mason, President and CEO of Rainy Mountain Royalty Corp., RMO on the TSX Venture Exchange. Rainy Mountain's Brunswick property is located in the Riaugh Shear Zone in Ontario, with grab samples running as high as 32 grams per ton gold. A follow-up drill program to test the numerous targets located by recent groundwork will commence later this year. Please visit our website at rmroyalty.com.
AMY.V Resources Limited is a gold exploration company with significant projects in British Columbia, Saskatchewan, and the Yukon. Trading on the TSX Venture Exchange, symbol ABN, and the pink symbol ABN-AF. Surrounded by world-class gold deposits and mines, AMY.V's 23,000 hectares Forest Kerr Gold Project is located in the heart of the Golden Triangle in northwestern BC. For more information, visit us at AMYresources.com.
I'm Larry Reaugh, President and CEO of American Manganese, Inc., listed on the TSX Venture, ticker symbol AMY, AMY, with proprietary patents in the U.S., China, and South Africa. Our focus is on recycling lithium-ion batteries for electric vehicles. China recently legislated the responsibility for recycling onto their electric vehicle manufacturers and importers. For more information, please visit AmericanManganeseInc.com or phone me, Larry Reaugh, at 778-574-4444.
This Week in Money is archived online at talkdigitalnetwork.com.
Welcome back to This Week in Money. I'm Jim Goddard. I'm speaking with Wolf Richter, publisher of wolfstreet.com. He's speaking to us from San Francisco. Wolf, you and the family pretty stuffed from all the turkey you had for American Thanksgiving?
Hi, Jim. Thanks for having me back. Yes, we went to a friend's house where a bunch of us got together, and we are stuffed. We will stay stuffed, I think, for a few days.
Getting on to the show here, once we've truly digested our last few big meals before Christmas, are the new stock market highs being reflected in the economy?
The economy has been growing at a frustratingly slow pace, as the Fed likes to call it, a moderate pace. Last year was 1.6%. In prior years, it was a little over 2%. This year, we're going to run over 2%. But in the past, we've had 3% or 4% growth rates, and they don't appear to be coming back. So we've had a stock market that can increase at 15 or 20% a year, and with many stocks having doubled in just a few years and quadrupled and so forth, and some of them, the overall market has doubled in 5 years. So the growth rates between the economy and the stock market are completely out of sync. And that's somewhat of a problem because, ultimately companies operate in the economy, and we've seen that in sales. So, corporate sales, for the S&P 500 companies are, they're sort of flat. They're talking about how sales are going to be up or higher than expectations. But when you look back at over the years, corporate sales are really not growing. Corporate earnings per share are kind of where they were in a few years ago. So I don't see a lot of growth in the fundamentals. The only thing that has grown for the stock market is the earnings multiple. So the amount of earnings compared to the price of a stock. And so for the S&P 500, this earnings multiple, this PE ratio, price earnings ratio, is now over 25, and that is very, very high. Traditionally, it's somewhere around 15, yeah. And so what we have seen is just this enormous amount of asset price inflation. This is really what it is. You get the same amount of earnings, but you have to pay a lot more to get it. And so the economy and the stock market have long ago separated, and that is logical. That is what the Fed has wanted to accomplish. Ben Bernanke spelled this out in 2010 in an editorial. Was very explicit about it. He called it the wealth effect. You make the wealthy wealthier, and they're going to spend more money, and that's going to help the economy. And he made the wealthy wealthier. Those that hold assets are a lot wealthier. They have spent a little more, but not a lot more. And so the economy is just lagged behind. And the disconnect between the stock market and the economic growth rates just show that very clearly.
Is bricks and mortar retail losing market share to e-commerce retail?
Yes. And retail in the United States is doing reasonably well. So Americans are borrowing more than ever before. So consumer debt has grown fairly dramatically, and so they're spending this money, and they're spending it on among other things, on retail items. And so overall retail, not adjusted for inflation, is up over a little bit of 4%. Now, brick and mortar retail without e-commerce is up only 3% year over year in the third quarter. Now, that's not a big growth rate. We've had about 2% inflation, so you take that out, so maybe it's only a growth rate of 1% year over year. Over the same time period, e-commerce has boomed by 15.5%, so a little over 15%. And the extraordinary part about this is that brick and mortar really comes in two halves. There's one half that is essentially online proof. There's one half that doesn't really have to compete with online retail, and that's new and used vehicle dealers There are franchise laws in effect in the United States on these are state laws, and they protect new vehicle dealers from out-of-state competition and from competition by manufacturers. So new and also the type of merchandise they're selling, these they're expensive big vehicles. There's a lot of paperwork involved, all kinds of registration and insurance. So these things are still transacted at the physical dealership. Grocery and beverage sales are, so vehicle sales are 21% of total retail. So that's a big chunk. Now, grocery and beverage stores, they're about 13% of total retail. And despite Amazon's efforts to get them online, they're still not online. Only about 1% of the groceries are bought online. The rest is still bought at physical stores. So that's a sector that is still relatively online proof. Amazon wants to change that, but Amazon has failed to do that. I mean, it has done a number of initiatives that have not panned out. Safeway has tried to sell online ever since the .com era, and it's doing it. You still buy the stuff and have it delivered, but it's just not. People like to go to the grocery store and look at their stuff before they take it home, and that's just how we're programmed to handle this. Gasoline sales, which are 8% of total retail, are obviously not going online, and restaurants and bars are obviously not going online, and they're 12% of total retail. So these online-proof segments, you add them all together, and that's 55% of total retail. So there's only 45% of total retail that's under attack from online competition. And that 45%, certain segments are getting decimated. And one of them is department stores. Department store sales peaked in the year 2000. And they have since declined 35%. And department store sales are almost the primary target of online sales. Everything the department store offers you can buy online, and more conveniently and with more choices and often cheaper prices. So department store sales in the United States have gotten crushed, and you can see that with malaise that our department stores are going through. That goes from Sears, which is nearly bankrupt, on to Macy's and many others that are having trouble in the physical stores. And so all the major department stores in the United States are trying to build a vibrant online presence, and some of them, like Macy's, are succeeding, and others, like Sears, are not. And so that segment is under heavy attack and is getting crushed by online retail. Toy stores have lost 35% of their sales to online. 35, that's a third. It's over a third. So, Toys R Us already went bankrupt, our largest toy retailer here. So in that 45% of retailers that are not online proof, that are really under attack, online is just eating their lunch. And that's not going to change. Long ago we thought online retail would slow down, that would level off. But year after year, it's been growing in that 14 to 16% range, and it hasn't slowed down at all. In fact, when you look at the chart, it's that the curve is steepening. It's now increasing faster than it used to. So, and people discover that they go to the department store, they go to another brick and mortar store, and because of the attacks from online, these stores are trimming back. There's nobody there to help you. They have limited merchandise. They don't have the size or color you're looking for. And you have a situation where you get frustrated. And that happened to me many times, and I finally don't go back. You can't get the help. You can't get the product. You end up having to go to several different stores. You waste a lot of time, and you don't get anything accomplished. And at home on the couch, you can do the same thing in 5 minutes and save some money. So every time this happens to a customer, there's an online convert. You have somebody that the retailer is sending somebody to the online business because they couldn't satisfy them. Now, some retailers are expert in merchandising, and they really do that well, and they give excellent customer service, and they're going to thrive, and they're going to have some key stores that do really well. And the retailers that are cutting back on service, and they're cutting back on inventories, and they're cutting back on merchandising because they're trying to save money, they're the ones that are going to be crushed the fastest. And Sears is a primary example of that, and other retailers are falling behind. We've had a number of retailers already went bankrupt this year. There weren't the big ones like Sears, but that is something that will not change. Online will continue to hit that sector really hard. And then, there will be shopping centers that are really glitzy and nice, and people will enjoy going there and make an event out of it. And there'll be stores that use online and physical stores combined, and Best Buy is doing that, and some others are, where you can order online and pick up at the physical store. Those kind of things are happening, and there's room for physical stores, but we have way too many malls, we have way too many retail stores like that, and that shakeout will continue for many years.
Wolf, as interest rates climb, are the banks making it tougher to borrow money?
That's an interesting question, because even though the Fed has raised interest rates, long-term rates really haven't climbed yet. Short-term rates have come up a lot, and they're at the highest level since 2008. But long-term interest rates have not moved up, so they're still very low. Mortgage rates, auto loans, all these are very low. And banks have been lending with very loose lending standards for the last few years, and that continues. So I don't see a tightening in the lending standards anywhere except in the subprime sector, and there banks are tightening. So the subprime sector and the auto loan sector, about a quarter of all auto loans are made to customers with subprime credit ratings, and their defaults are now spiking to financial crisis levels. They're nearly, the 90-day delinquencies are at nearly 10%. That is huge, and banks are reacting to that. And in fact, most of the subprime auto loans are not handled by banks, but by special auto lenders. They're specializing in that, and they're turning these subprime auto loans into securitized products, so they're selling them as asset-backed securities to other investors, and they have not paid a lot of attention to credit risk, and they're getting crushed. So these subprime auto loans are going sour, and the ones that banks are dealing with are not. They're holding up pretty well, because the banks have been a lot more careful with them. But the ones that the specialized auto lenders are doing, with a default rate, with a 90-day delinquency rate of nearly 10%, that is really bad. But outside of the subprime sector, I have not seen any tightening of the lending standards. And that's interesting, because the Fed is tightening, and the Fed is tightening in response to the loosey-goosey lending standards we have in the United States, and they're trying to tighten up, financial conditions. They're trying to get lenders to be a little bit more prudent and to take some liquidity out of the market, and that just hasn't happened yet. So it will eventually happen, and then it will be a little bit more difficult to fund certain things. But at this point, banks are really lending without any kind of hesitancy, except in the subprime sector. Even junk bonds. Junk bonds were in a downward spiral in early 2016, mostly because of the energy junk bonds. But they have since boomed, and junk bond yields have come down very hard. They're now at 4.5% approximately for BB-rated bonds. That's very low, and so junk-rated companies can get funding without any kind of problem. So I don't. Eventually, we'll see that, but that just hasn't happened. There has been no tightening of financial conditions in this market, except on the consumer subprime sector.
If the banks constrict credit, does it matter where interest rates are?
When banks constrict credit, interest rates will spike. And that happened during the financial crisis when banks started turning off the spigot. Essentially, they're saying, I'm not lending you money anymore at 5%. And then you go back there, at what rate will you lend me money? And they say maybe at 8% or 10% or whatever, and they will lend money, but they won't lend it at the rate that you can handle. And this is considered credit tightening. I mean, they will lend, but the rates will be higher. And the rates will be higher to a point where people that have been, or businesses that have been spoiled by low rates can't borrow anymore. And so a credit crunch has that effect. A credit crunch means that rates go up and the borrowing costs go up, and that businesses and consumers can no longer afford to borrow at those rates, and then will curtail the purchases. That hasn't happened since the financial crisis, so I don't see any signs that we're near it. It happened in the energy sector starting in late 2014, early 2015, and really taking off mid-2015 and late 2015, and when banks really cut off the flow of money to energy companies, and a bunch of energy companies that couldn't refinance the debt went bankrupt. That phase is now over. The Wall Street has reopened its big wallet to energy companies, and they're funding everything in sight. So that problem has disappeared. Retailers are starting to run into that problem where lenders are leery of extending more credit. So that will take down some of the bigger retailers, and Sears being one of them. That's what a credit crunch will do. It will weed out the weakest elements, and with the worst credit, because they can no longer fund at survivable rates. And a company like Sears may not get any bank credit at all anymore. If it no longer has any collateral it can pledge, it may be impossible for a retailer like that to fund its operations. Retailers don't do well in liquidation, and most of them end up there when they go bankrupt. Lenders are scared of that. They will not get much of their money back, and so that is a place where tightening is taking place, and should have taken place a long time ago, given the condition the industry is in. But overall, the economy, in terms of just general tightening, I don't see that yet. And if it happens, I don't think it will be a big thing, at least not next year. I think there will be some minor uptick in some of these things, but I don't think it will be a very big issue.
Are real estate bubbles in the U.S. continuing to grow?
Yes. And real estate being local, these bubbles are growing locally. In some places, they're ballooning at an incredible pace. And in other places, they've kind of hit the ceiling. And San Francisco is one of those places. It's probably the most expensive city in the United States. And we look at the Case-Shiller home price index, and that covers the city of San Francisco plus 4 counties surrounding it. So that's really not a pure San Francisco index. But the median price of the city in San Francisco, so the median price of houses has shot up in October again, but the median price for condos in October was actually below the level a year ago and about flat with 2 years ago. So in terms of the apartment market, so condos and TICs, this tenancy in common that we have in San Francisco, which is a different legal way of structuring an apartment building, they have flattened out, and there's a lot of supply coming on the market. There are high-rises being built everywhere, and so price increases have hit the ceiling, with an average, the median condo costing around $1.2 million. That's very high. A median condo is not a luxury palace. It's a 2-bedroom thing, and you're lucky you have a 1-car garage with it in a high-rise building, and so that's a lot of money and you need a lot of income for something like that. And there's not an unlimited market for this, so they're running into trouble. Apartment rents are already coming down in San Francisco, so I think San Francisco has seen sort of the peak of the bubble. Other cities are still exploring ever further, ever bigger highs, and until they hit their peak too. I mean, these things don't go on forever, but they're overall, the United States real estate market is still very nicely bubbling, and in some cities it's just extraordinary how fast these property prices are appreciating.
What effect will the tightening of credit have on the real estate market?
Well, when it eventually takes hold, so when we see mortgage rates go up, and that hasn't happened yet, you still get a 30-year fixed-rate mortgage for under 4%. So when mortgage rates go up at these prices, affordability becomes a much bigger issue. And so mortgage rates going up 1 percentage point will have a dramatic impact on the most expensive market. So on a condo that costs $1.2 million, a 1% increase in mortgage rates has a $12,000 annual increase in interest payments with it. So yeah, you have to pay an additional $1,000 a month here. So that moves that much further out and out of reach. So what will happen is that consumers will shift down. They will try to look for cheaper property and that they can afford at these higher interest rates, and that will let the air out of the market. And that's practically guaranteed. If we see and when we see mortgage rates go up, we will see that reaction in the market. We just have not seen it yet. So we have not had any sustained increase in mortgage rates.
The Canadian government is imposing a very stiff means test in the new year. It pretends that interest rates have gone up, I think, 2%. Can you still pay a mortgage at that rate? Is that a good idea, that stress test people before they buy?
Yeah, you would think that that lenders would do that automatically. With adjustable mortgage rates. In Canada, most of your mortgage rates are adjustable, so and some of them adjust almost immediately, and others adjust a few years down the road. And so interest rate hikes impact homeowners in Canada a lot more than they do in the United States, where adjustable rates are really just a small part of the mortgages. Most of our mortgages are fixed rate, either 15, 20-year or 30-year fixed rate. And the 30-year fixed rate mortgage is standard. So if you buy a house today and your interest rate is 4%, it will remain 4% for the next 30 years. If you buy a house with an adjustable mortgage rate and over the next 30 years, rates go up 4 or 5 percentage points, your mortgage payment is just going to go through the roof. And that is a problem in Canada, and a much bigger problem in Canada than in the United States. And I think it is a very appropriate move, and it should have been done from the beginning. I mean, when you have an adjustable mortgage rate, you should price in when you approve the loan, you should price in higher mortgage rates to see if the borrower can meet those higher mortgage payments with the income that they have and that they expect to have. So, I mean, I think it is very prudent to do that with adjustable mortgage rates. I mean, you don't want a borrower buying a house that they can't afford next year. That's catastrophic when you do that, or can't afford 2 years from now when they get a 3% raise in salary and the mortgage payment jumps by 10%. And, I think it's very wise to do that, very prudent, and it should have been done from day one.
The auto market. Do car dealers still have new 2017 models on their lots?
Oh yeah, there's plenty of them. And, there will be plenty of them for quite a while. When automakers built the current model year, they expected to have higher sales figures than they're having, and especially in cars. Trucks and SUVs is not as critical, but in terms of car sales collapsed this year essentially, and so there's a lot of cars out there. Truck sales have been fairly strong, so the truck inventories are not extraordinary, and the 2017 model years are not, for trucks and SUVs, are not that out of range. But in terms of cars, there's a lot of stuff parked around that needs to sell. And automakers have responded. They have shut down factories and they've laid off people and they've cut production. So they've reacted, but the reaction was a little late, and the oversupply is still in the market, and it will have to be whittled down.
Are the automakers offering significant incentives?
They are, and they have been offering them, and they were and are at record levels. They're now averaging around 10% of the retail price of MSRP. That's very high. On the other hand, automakers have raised their prices. Their cars have gotten very expensive. On trucks and SUVs, automakers have huge profit margins, so they can afford to put those incentives on. So among automakers, there's actually discussion, and several CEOs have indicated that they've gone too far in their price increases, that over the years, these vehicles have gotten too expensive, and these incentives are really nothing more than backpedaling on some of these price increases. So if you buy a $60,000 SUV and you have manufacturer's rebate and incentives on it of about $6,000, what the manufacturer is saying, the retail price on this vehicle should be $54,000, not $60,000, and we screwed up by raising the price over the past few years to that higher level. And this really is a big problem. In the inflation numbers, this doesn't show up because a vehicle gets new equipment added every year, and the cost, the imputed cost of that new equipment gets subtracted from the inflation figure. So if I have a vehicle that costs $60,000, and as an automaker, I add $2,000 worth of equipment on that, I'll make standard the following year, and I charge $62,000 for that vehicle next year. Then inflation, essentially the way the inflation is figured, it assumes that there's zero inflation on that car because, you're paying more, but you get more. And this could be equipment, it could be performance, it could be other things of value that are deemed of value. So vehicle prices have shot up by a significant amount over the last 5 years. And at the same time, the inflation for the CPI for new vehicles has barely budged. So, and consumers don't react to CPI; they're reacting to the actual price on the window, and that has gotten very expensive. And that's called sticker shock. When you're out of the market for 5 or 6 years, and you go back and you realize just how expensive these vehicles have gotten. And that's you can do that for a while, and then consumers whose incomes haven't risen enough are finding that they can't do this anymore, and automakers need to stimulate sales by lowering the price, and they're not lowering prices, they're giving incentives. So that's what they're doing. Actually, they're cutting the price of these vehicles by about 10%, and on average, some of them a lot more, some of them less, and that's a recognition that they've raised prices far too fast over the past few years.
If there's extra cars on the lot right now, does that spell trouble for the 2018 model year?
It doesn't help, that's for sure. The hurricanes have taken several 100,000 vehicles off the road, so that will boost demand temporarily. The hurricane in Texas particularly, and demand in Texas is for trucks and SUVs, not for cars. So that has alleviated some of the inventory problems on the truck side. I think inventory-wise, 2018 will be okayish, in part because automakers also have cut production to bring it in line with the lower demand. So I think 2018 will see inventories more in line with what is considered normal, which would be about a 60-day supply. And we're way above that now, but it's coming down. So I think next year we'll be in the normal range, or close to the normal range.
Are the prices of used vehicles on the rise?
Yes, they are. And that said, they have declined substantially, depending on the measures you look at. And that's the interesting thing about used vehicles, and that's wholesale and that's retail. On the wholesale side, especially, so that's auction vehicles, the indexes we have, which is the Mannheim Auto Auction Index, and that's the biggest auction house in the United States for vehicles. And their prices have surged. So they're up 10% from March. They have never really gone down over the last few years, even though the price indexes of other vehicle data companies have gone down. So, for example, the National Automobile Dealer Association, its used vehicle price index peaked in September 2014, and it plunged, and it went down like 13% or so from there over those years, and particularly hard late last year and early this year. And so that was a very steep decline, and it's a very broad index that tries to value the fleets that rent car companies have, and other. It goes across all kinds of model years, and so it's considered the broadest index. And the fact that it declined so much caused a lot of hand-wringing in the industry, because it pulled the rug out from under new car sales, because it lowered trade-in values, and it caused all kinds of problems with lenders and with leasing companies and so forth. And so that index seems to have bottomed out a few months ago, and is now rising too. From Edmunds, we hear that the prices that rise the most are of vehicles that are 10 years and older. So on the older segment of the used car market, because that's what people can really afford. They're really looking for good cars that have 100,000 miles on and they're 10 years old, because that's what they can afford. And so at that segment, prices have risen the fastest. That's what Edmunds is saying. So we're getting all these different bits of data in that essentially say that right now, and even the consumer price index for used vehicles has turned around. That has plunged over the last year, and that has now turned around a few months ago. So pretty much every data point that we're looking at now is saying is agreeing with the other data points, and is saying that prices are now rising, and that they started rising by some measures 3 months ago, and by other measures that they never fell, and that they're now spiking. So the Mannheim index has spiked 10% in just a few months, and others are a little bit more sanguine about that.
What do you see ahead for electric vehicles?
There were electric cars before there were cars that had internal combustion engines. So electric cars have been around forever. Electric cars competed with steam-powered cars at first. And electric motors are far superior to internal combustion engine motors in the way they operate. They're simple, they're light, they're small. They have a flat torque band, so you don't need a transmission. Whether an electric motor turns at 50 RPM or at 2,000 RPM, it has essentially the same torque, which makes them incredibly handy for transportation applications. And so, electric subways, trains, that's been the way to go. High-speed trains are all electrically powered. The problem is that you have to get electricity to them, and that's been the issue from the first day. That's been the issue since the 1800s, when electric motors were powering cars. You need a battery, and trains, they have the overhead wire, the third rail, and that works. But in a car, you need a battery, and the battery is a technology that's really the weak link in all of this. Now, the battery performance has improved dramatically, and it improves just in quantum leaps every year. And it has now gotten to the point where electric cars are, with the batteries that are today available, are functional. They have a good range. You can charge them up pretty quickly. It's still not ideal. A battery's still expensive. It's the most expensive part of my car. It's still heavy, and it's still very costly, and it still takes too long to charge. So they still have a little ways to go, but But I'm at the point where probably the next car we buy will be electric because I think they're good enough. They're cheaper to operate. They're fun to drive. They have really nice acceleration. They're quiet. I don't think anybody worries about the environmental aspects of it. I think it's all about how the vehicle operates, operating costs, whether it does what you want it to do. And I'm about ready to, we're not going to buy a new car this year, next year, but the next one we'll buy will probably be electric, and a lot of people are thinking that. Every major automaker in the world already has electric vehicles out or is preparing them for sale, and they're switching whole product lines over to electric cars. So this is something that has achieved critical mass, and I think this will continue to spread. Now, cars last a long time, so if you buy a car today, you're not going to replace it very quickly. You can sell it after a little while, but then somebody else is going to buy it. So in terms of the vehicle fleet that's on the road in the United States, that will remain largely dominated by internal combustion engines because it will take decades to replace them. But little by little, the electric cars are going to make headway, and I think for urban driving, they're far superior to the internal combustion engine.
Is the rush to self-driving vehicles an accident waiting to happen? Okay, so I live on a kind of a dangerous intersection, and just the other day, and there's accidents all the time where we live, and the other day, some guy came down the hill, or several people in the car, ran a red light, and hit two cars. And there were injuries, and it's just another accident at the intersection. There's a number of them every year. And human beings are terrible drivers. They run red lights, they get tired, they get drunk, they're under influence, they get distracted, it's raining or it's dark, human beings can't see anymore. So last year in the United States, about 40,000 people were killed in motor vehicle accidents involving human drivers. So human drivers are terrible. And anything that will improve that will be better. So if self-driving cars don't have to be perfect. They only have to be substantially better than human drivers. And that's not that hard to do. And if if you can get the accident rate down by 50%, by switching to self-driving cars, that will be a huge improvement. And insurance companies will jump on that. And so that's the challenge right now, is to make the systems work. I think in terms of safety, they will be far superior to human drivers. Human drivers are just the worst. They're the only drivers right now we have, but they're just terrible. And, they get impatient, and I get these people say, well, I'm 5 minutes late to work. I need to drive faster. I need to cut some corners to get there to make up the 5 minutes. Well, that's why human beings are terrible drivers, because they get in a hurry, and they don't follow the traffic laws anymore, and they take risks, and they kill themselves and kill others in doing so. A self-driving car will not do that. It will follow the rules, and if you're 5 minutes late, well, you're going to be 5 minutes late. It's just how it is. And so I think once the self-driving cars are ready for prime time, which they're not, and they won't be this year, next year, they'll gradually be phased in. There'll be big taxi fleets first, like Uber and others will have them first, and they will test them. They're already on the road. They're already being tested. They're driving millions of miles every year. So they're out there, but they're not out there as a retail product. So for a car dealer to carry a self-driving car for a retail customer to buy, that is a number of years off. And so I don't think that will happen that quickly. But when these cars are ready for the, I think the safety aspects of it will be far superior than human-driven vehicles. It just
humans are just terrible. If you look at the traffic fatalities and why people have accidents, these are human foibles that self-driving cars just don't have. So, I don't think safety is an issue with self-driving cars once they get to the point where they're ready for prime time.
Do self-driving vehicles require 5G networks to operate?
Well, ideally, self-driving cars will communicate with each other, with other self-driving cars that are out there, and with a server that is somewhere else. So that will be via some kind of a cellular network. So it could be G5, it could be something else. And self-driving cars will also be able to handle normal traffic situations without communications. So just like a human being, when you're driving down the road, you have to respond to the things that are in front of you, and behind you, and next to you, and you're not in communication with any of these things except what you see and hear. And self-driving cars are, in a sense, the same. So they will be able to do all these things. They have sensors that are far superior to our eyesight. They can see in the dark, and they can see in rain and in snow. And so they'll be equipped to handle this. At the same time, any input you can get, so vehicle-to-vehicle communication or input from the central server will give that self-driving car far more information than a human driver will ever have. So all of these systems will eventually work together. Again, we're talking years down the road, so the data transmission rate between a self-driving car and the server, I don't think is that critical, because really a self-driving car needs to have everything on board that it needs to drive. It can't rely on wireless communications, because you can interrupt that and they can lose it. And so they need to have everything on board they need, just like a human driver. Yeah. And then there'll be communications, but I don't think it will require a huge amount of bandwidth.
The buzz is on for cryptocurrencies. Are there numerous risks to using cryptocurrencies?
Well, we have now like 30 major hacks into cryptocurrency exchanges. So they're software-based, so they get hacked, and money disappears without trace. And this is a risk that you have. Other cryptocurrencies are just plain scams. We just had another one. Or a startup issued a cryptocurrency in an initial coin offering. The startup is called Confido, and the people that did that, they raised a lot of money. They raised about $375,000 that way, and they just disappeared with the money. They're gone. They just collected this money and left. And these initial coin offerings everybody can do them. There's been hundreds of them. There's been all kinds of issues with them. They're incredibly risky. You don't own the company. When a startup does an initial coin offering, they give you a token, and you hope that you can trade it as the price rises, but that token doesn't convey any kind of ownership in the company. So it's just a donation to the company. In an ICO, you just donate money to the company essentially, and you get a token in return that you can trade. And a lot of times, that falls flat. And so there are over 1,000 cryptocurrencies out there now. Everybody can start their own. Hundreds of them are worth nothing at this point. They have just completely collapsed in price. Everybody, the media, focuses on the ones that are booming, but the ones that are collapsing just disappear from view. And people lose real money in this stuff. So, in terms of trading, you have those kind of risks. I consider it an online, a form of online gambling, really. That's all it is. You take big risks for big gains, and you go with it. In terms of using cryptocurrencies, when prices fluctuate, and we've had a cryptocurrency the other day, Bitcoin Cash, that quadrupled in 4 days and then recollapsed. So if you try to buy something with a currency that has these kinds of violent price movements, you take on a huge risk, both as a vendor and as a purchaser. And you would have to hedge against this risk, and that is very expensive. So in essence, when cryptocurrencies have these violent price movements, you can't use them anymore for legitimate transactions because you don't know what you're going to be paying. I mean, it takes quite a while to get these transactions done, and in the interim, the price changes, and what you think you're paying and what you actually end up paying, or what you think you're getting for your product and what you're actually getting is going to be very different. So I think with these violent price movements, cryptocurrencies have moved out of the usable currency spectrum, and they're now just a speculation medium, and it's a form of online gambling. You know, you jump into it and you try to make a quick buck, and hedge funds have jumped into it, and a lot of other speculators have jumped into it, and there's a lot of market manipulation going on. The exchanges are not regulated. A lot of them, some of the biggest ones, are very opaque. You really don't know what's going on. Some of them have just disappeared and shut down. You know, the exchange shuts down. You don't get anything. Your cryptocurrency is gone. So this is the Wild West out there, and I just posted an article on my site that shows the last 30 hacks of cryptocurrencies, and some of them have had very significant losses for people who've had cryptocurrencies at these particular exchanges. So definitely the risks are very big.
Are there any barriers to being able to create a new cryptocurrency?
Essentially none. Anybody can create it. To get it off the ground and get people to buy into it, you have to market it, just like anything. And you know, and if you can't get other people to buy it, the value will be zero, and there's no trading taking place, and that's been the case with hundreds of them. So yeah, I can start my own cryptocurrency, and I can sell them via an ICO, and I have a pretty active website, so I can actually promote it, and this will be considered a donation by the people who buy this thing to me or to my company, and they'll never get anything. You know, they can trade this stuff amongst each other, hoping to come out ahead, but they'll never get anything from me. And that's the principle, you know, and so anybody can do it. Lots of people have done it, and a lot of them have fallen flat.
Do people remain anonymous when using cryptocurrencies?
They remain anonymous to an extent, but blockchain, the way it works is that every transaction is recorded. So that ledger goes back all the way, and it records everything. So you may be not named in that ledger, but the transaction is in it. And that's the same with Bitcoin and the same with others. So they have traced that Bitcoin transactions back that way. And so it's not like cash. You know, you walk into a place with a suitcase full of cash to buy something, and the cash that you're handing over is random, just random numbers. They're not, nobody counted them. So the serial numbers of the bills, and nobody knows later where this cash came from and how you got it. You can't follow it. So that's a truly anonymous purchase. There are other forms of truly anonymous purchases. Cryptocurrencies that are based on blockchain don't offer that kind of anonymity, simply because every transaction is recorded in the blockchain. And you can't, that's the basic principle. You can't get away from that. So your name may not be in it, but the transaction is in it.
Do cryptocurrencies have hidden costs and fees like the fees charged on credit cards?
Well, they're fees by the exchanges, maybe fees by exchanges. They're fees when you actually buy something with a cryptocurrency. You know, they're transaction fees, and they can be fairly high, especially for small purchases. I think the biggest risk when you use cryptocurrency for purchases is simply the fact that the prices move so fast that you don't know actually what you're paying or conversely what you're receiving in terms of money. It changes by the time the transaction is over. So I think that risk is far greater than a fee would be. And price movements have been very significant from one minute to the next sometimes, and so I think that's the bigger risk. With Bitcoin, for example, the transaction costs vary, so you don't know in advance what it's going to be, and they can spike significantly and they can drop back down and be fairly low. And it's not a flat fee. When you do a wire transfer with your bank, it's going to be $30 if it's an international transfer. You know that in advance. It's going to be $30 whether you do a $100 transfer or a $100,000 transfer. With a Bitcoin transaction, you don't know in advance what it will cost you.
What are you bullish on and what are you bearish on for 2018?
I think it's very difficult to be bullish on any asset class after global central banks have spent the past 8 years inflating just about every asset class out there. So, at these elevated prices, whether it's real estate or stocks or bonds, at these prices I would be very leery, being bullish. At the same time, it's kind of a crazy environment, so it could very well be that the stock market continues to go up, but I'm not convinced it will. I know the bond market will be a very unsatisfactory place to be over the next few years, and it's already suffering. And so I'm definitely not bullish on the bond market. I'm fairly bearish on the bond market, actually. I think there's some room in the commodity space, short term, so the next few months, not a year, but the next few months, next 4 or 5 months. Natural gas, yes, natural gas may be something I could be bullish on, simply because supply, even though it's at record levels, is meeting demand that's even higher. So we've drawn down our inventories. We're exporting natural gas from the United States, both as liquid natural gas and pipeline exports to Mexico. And there's more natural gas being used. So I think that this next few months might be positive for natural gas. People ask about gold all the time, and gold and silver, and silver was the first asset where I really lost a lot of money with in the 1980s, and I waited till the price had collapsed 30%, and I bought, and but it continued to collapse for another 15 years or something. So these precious metal cycles are very long, and they don't exceed my patience. So gold's been going down for 11, so what would it be, 5 years or something like that. I don't think we're at the 10 or 15 year cycle limit. So it's just really hard to be bullish these days. After 8 years of inflating asset prices, it's just really hard. I'm definitely bearish on bonds, as I said, and and real estate to some extent in some cities. I think in some cities it's if you're an investor who wants to capitalize on the high prices, in some cities it might be a good time to get out.
Wolf, can you tell us a bit about wolfstreet.com?
We focus strictly on the economy, on finance, and on business issues. Everything is free. We try to tell the story behind the story, and we have a vibrant commenting community. We try to keep it polite and interesting. Our commenters are smart, and it's a good read. So come on by, wolfstreet.com.
Wolf, thanks a lot for being on This Week in Money.
Thank you, Tim.
My guest has been Wolf Richter, publisher of wolfstreet.com. He was speaking to us from San Francisco. And that wraps up our show for this week. We'd like to thank our guests, Bob Hoye, Doug Casey, and Wolf Richter. And thank you for listening. Plus, stand by for a company showcase update with American Manganese CEO Larry Reaugh. If you have any questions for the show, you can email us at info@howstreet.com. I'm Jim Goddard. We'll be back next week with more This Week in Money.
Comments made on This Week in Money are an expression of opinion only and should not be construed in any manner whatsoever as recommendations to buy or sell any financial instrument at any time. Archived online at talkdigitalnetwork.com. This Week in Money is a production of Howe Street Media Incorporated. Executive producer is Tom Allen. Welcome to Company Showcase, an advertising feature on HoweStreet.com.
I'm Jim Goddard. I'm speaking with Larry Reaugh, President and CEO of American Manganese. Welcome back to the show, Larry.
Well, I'm always glad to come back on the show, Jim.
Larry, you have new patents coming up?
Well, what I'd like to explain about that is that during the patent process that we just went through to file the two patents, we actually found ways of potentially improving that, not potentially, but actually improving the streamlining the processing plant, and which would reduce costs and a few other things in operation, and efficiencies would be better. So we will be looking at filing new patents in the coming year. And I know that our listeners are curious about what the plans are going forward for the company. Well, we're waiting for the budgets from and the design of our pilot plant from Commodco. So all I can tell you is that I don't know what the budget's going to be, and I'm not exactly certain when we will receive the budget from Commodco, but that is going ahead next year. And but I really wanted to talk about, as we're coming towards the end of the year here, and recycling is a big part of the lithium-ion battery chain, but it was relegated to the back end of well, that's kind of a pun. Relegated to the back end in everybody's mind, that it wasn't a real requirement for a number of years. But now you're starting to see articles coming out, and you've seen the one from Thomson Reuters on the company, where people are beginning to realize that the battery manufacturer and the EV cars have got to do something about recycling the entire battery. Because you can't say that you are a green, environmentally conscious company, and you're doing nothing about the batteries, which is probably handling those batteries at the end of the life cycle is one of the biggest things that could contaminate the environment. So now you're starting to see us getting into the mainstream. Mainstream being, we're starting to get talked about. We're starting to hear more and more on the recycling. We've had several articles that have been done by us in the recycling magazines, and actually in an oil and energy publication, and there's going to be more coming. So that takes me one step further. This last year has been dominated by cryptocurrencies, marijuana stocks, and actually lithium. Lithium stocks are burning up the charts. Cobalt, still, just starting to raise its head, get a little light out there, but that's coming. I can see that. Cobalt and recycling are going to be big topics next year. And I'd just like to take everybody back and say, okay, what do I relate my visions on this? How do I relate them? What do I relate them to? Well, I've been involved in off the radar commodities before. And the first one was molybdenum. And molybdenum, nobody could even pronounce the word back in 2003. Everybody had totally forgotten about it. And the price had started to move up. And it moved up pretty rapidly. And we were talking about molybdenum, the only ones talking about it, just like we are recycling. And until a couple of years later, Sprott formed up the Moly Fund, nobody was really getting excited about molybdenum. But after that, it became a hot item. Went from one company when we started to, 200-300 companies were involved in molybdenum within 2 to 3 years. And the molybdenum stocks started to churn up just like the cryptocurrencies or the marijuana stocks or the lithium stocks. We went from about $20 million market cap in 2005 to a market cap of $300 million in 2006. So this is the kind of thing that you can look forward to. And I know my shareholders have been patient. They've wondered why people haven't recognized it. Well, I think that recognition is coming, and we're going to have a fantastic year next year. So I'm looking at a couple of areas that will definitely outshine the rest of the market. And that's going to be in the recycling and the cobalt. And guess what? We've got our feet firmly in both of those camps. And even with the recycling, we're going to be a significant cobalt producer. And also with lithium, we're going to be a significant lithium producer out of these batteries. And that's what people are beginning to recognize. Nickel, manganese, aluminum, all of those commodities that we can get 100% back. Now, what does that mean for our shareholders? I think their patience is going to pay off. I mean, we all get frustrated when we know we got something good, and I've known that for some time. Then when it gets recognized, you wonder you forget about the battles that you fought. And you just see that, hey, we're going to get rewarded. And that's what I want to see the shareholders do. Get rewarded for their patience and their trust. And, this is a Friday. We put out a few articles that have been written about us in the last week. And, I expect that we'll have more coming in the future. And, I'm happy to say that, the momentum for the, recycling story is starting to gather speed. And what that means is that we're going to be getting a lot of attention, whether it's in financings, whether it's in potential joint ventures, whether it's in off-takes of some of our product. I couldn't tell you at this point, but it's going to be a very lucrative, busy year for the company next year. And so I don't want to wear everybody out. I just want them to know what I see coming down in the future and what they can expect to have happen in the budgets for next year. And I wish them a great weekend.
Larry, for new listeners, could you maybe give us just a bit of a background on what American Manganese does?
American Manganese is a critical metal company that is focusing on the recycling of lithium-ion batteries utilizing existing technologies that the company has patented. And we've now got patent pending on 2 other patents that have just been recently released for the recycling. The company is traded on the TSX Venture Exchange under the symbol AMY. It's traded on the U.S. exchange under the symbol AMYZF, and it's traded in Frankfurt under the symbol 2AM. You can check out the company, do your due diligence at our website, AmericanManganeseInc.com. You can contact the company through me at LREAUGH@AMYMN.com, or give me a call at 778-574-4444.
Larry, thanks for the update.
Thank you, Jim.
My guest has been Larry Reaugh, President and CEO of American Manganese. I'm Jim Goddard. We were speaking on November 24th.
Comments made on Company Showcase are an expression of opinion only and should not be construed in any manner whatsoever as recommendations to buy or sell any financial instrument at any time. Archived online at HowStreet.com. Company Showcase is a production of How Street Media Incorporated.